Global sovereign debt now exceeds $300 trillion. The total above-ground gold stock at market value is a fraction of that number. If even a small percentage of global bondholders attempt conversion into gold under stress, the arithmetic does not clear. This has happened before. This is Solidus, where history and money collide. If you follow structural signals before they become headlines, subscribe. In March 1968, the London gold pool collapsed after hemorrhaging 3,000 tons of reserves in less than 3 years. The mechanism was designed to stabilize price. Instead, it functioned as a transfer system, converting sovereign gold into private hands at a fixed discount. What appeared to be monetary defense was liquidation under structural constraint. The pool operated on a controlled structure. 7 central banks sold gold into the market whenever private demand pushed prices above $35 per ounce. The goal was to suppress the widening gap between official valuation and real scarcity. But the structure contained a fatal asymmetry. Central banks could only sell. Private actors could only buy. And the price was fixed. Every new dollar created through fiscal deficit, trade imbalance, or credit expansion generated an additional claim against a finite stock. The ratio moved in one direction. By 1965, outstanding dollar liabilities exceeded U.S. gold reserves. By 1967, the gap widened monthly. The system was not stabilizing, it was draining. Intervention intensified. From 1965 to 1967, gold sales tripled. Participating central banks converted reserves into flow, feeding a market with no structural ceiling on absorption. France withdrew in June 1967, labeling the arrangement a subsidy. The description was precise. Fixed-price sales with unlimited access create one-way arbitrage. The mechanism was offering scarce collateral at a discount to any actor holding currency. Acceleration did not come from panic. It came from recognition. Governments, insurers, and corporations observed that claims were expanding faster than underlying metal. Conversion became rational before it became urgent. This is the structure of a bank run scaled to sovereign balance sheets. By November 1967, the pool was supplying 100 tons per week. The Bank of England sold into effectively infinite demand at $35. There was no equilibrium at that price, only depletion. Within months, the arrangement collapsed. The two-tier system that followed, official gold at $35, market gold floating, was an admission that the arithmetic had failed. The failure was not operational, it was structural. Gold as a reserve asset functions only when scarcity is preserved relative to claims. The pool inverted that relationship. It expanded claims while draining the scarce asset at a fixed rate. The defense mechanism became the vulnerability. This constraint generalizes. In a debt-based monetary regime, the numeraire must expand to accommodate credit growth. If the numeraire is anchored to a finite physical asset, the system approaches a hard boundary. Market suppression cannot alter ratios. It can only delay recognition. Gold does not appreciate because of crisis alone. It appreciates because fiat claims expand without endogenous limits. When credit creation outpaces scarce collateral, the repricing is mechanical. Intervention cannot resolve that contradiction. It reallocates it. Now consider scale. Global bond markets exceed $130 trillion. The entire investable gold market is a fraction of that size. Annual mine supply adds only a marginal percentage to total stock. If even 5% of sovereign bond holders attempted structural reallocation into gold during systemic stress, the market would not absorb the flow without violent repricing. Gold does not need universal panic. It requires marginal capital flight. When the first layer of holders reallocates, price adjusts. When the second layer follows, liquidity thins. The third layer pays the adjustment cost. This is the mechanics of dilution recognition. Investors stop pricing nominal repayment risk and begin pricing purchasing power risk. Yield caps, quantitative easing, and fiscal expansion increase the stock of claims. Scarce assets do not scale proportionally. The ratio widens quietly until it becomes visible. Consider a parallel structure, a sovereign bond market where yields are administratively capped and central banks commit to unlimited purchases at par. Issuance accelerates to fund deficits. The monetary base expands to clear supply. Nominal stability is preserved. Structural scarcity is not. Holders begin reallocating into harder assets, commodities, land, equity, gold. not because default is imminent, but because dilution is measurable. The central bank continues absorbing issuance. The ratio of liabilities to finite collateral widens further. At a threshold, the system transitions. The question shifts from nominal solvency to structural preservation of value. Contraction collapses. Leverage. Continued expansion validates exit. There is no neutral path once recognition accelerates. This pattern is not ideological. It is arithmetic. Any reserve asset anchored to a claim issuance system without endogenous limits inherits the same tension. The gold pool was an early demonstration. Participants faced a choice between sovereignty and convertibility. They chose sovereignty. The imbalance persisted. Gold under capital flight is not insurance against chaos. It is insurance against dilution. When liabilities scale faster than scarce assets, price suppression becomes a transfer mechanism. The entity defending the ceiling subsidizes early movers. In 1968, that subsidy ended when reserves depleted. Over the following decade, gold repriced multiple times higher. The move was not speculative excess. It was structural release. The cap dissolved. The ratio reasserted. The gap between expanding claims and finite collateral does not disappear. It is managed through credibility, policy tools, and preference. As long as the liability remains the preferred numeraire, the system sustains. Preference, however, is conditional. It depends on the belief that exit remains orderly and value remains transferable. Once that belief erodes, even marginally, the repricing begins. Not collapse. Repricing. Slow at first, then discontinuous. The entities holding liabilities longest absorb the adjustment. Those who moved into scarce assets earlier benefit from the spread. The mechanism resembles a queue more than a market. Sequence determines outcome. Gold occupies the terminal position in that queue. Not because it yields return, but because it carries no issuer. It cannot be diluted through policy decree. Its supply curve responds to geology, not stimulus. The critical distinction is this. Gold does not stabilize a debt-saturated system at scale. It exposes the scale of imbalance. If the volume of claim-seeking collateral exceeds available supply, price must expand to ration demand. The metal survives. The structure reprices. The gold pool attempted to defend a nominal level. The ratio overruled it. When price and arithmetic diverge, arithmetic prevails. The open question is not whether gold will hold value in the next stress cycle. It is whether systems built on accelerating claim issuance can absorb recognition without disorderly repricing. Intervention can defer adjustment. It cannot eliminate constraint. When the ratio becomes visible, the exit begins. And once exit begins, the mechanism runs until the imbalance is priced in full. Liquidity adds a second constraint. Gold markets appear deep under normal conditions, but much of that depth is synthetic. Futures, swaps, derivatives layered over limited physical stock. In stress, preference shifts from exposure to settlement. When paper claims compress toward delivery, liquidity thins rapidly. The same ounce cannot clear multiple exits simultaneously. Price stops reflecting speculation and begins rationing scarcity. Scale compounds the problem. Sovereign bond markets exceed $100 trillion. Annual gold supply expands marginally relative to existing stock. Policy can create trillions in months. Mining cannot respond on that timeline. The mismatch is not ideological, it is temporal. Speed now replaces delay. In 1968, recognition spread slowly. Today, reallocation synchronizes. Exchange-traded vehicles allow institutional capital to rotate instantly. Recognition compresses. The ignore phase shortens. Once marginal holders move, price validates movement. Validation accelerates rotation. The queue tightens. Gold does not stabilize this process. It bottlenecks it. If even a small percentage of duration-sensitive capital attempts structural exit into non-issuer assets, repricing becomes nonlinear. Not because gold is insufficient in value, but because it is insufficient in scale relative to liabilities seeking refuge. The metal survives. The adjustment migrates outward. Rising gold under such conditions signals not protection, but exposure. It indicates that claims are expanding faster than trust. Trust cannot be printed. It must be preserved through credible constraint. Without constraint, dilution becomes the adjustment mechanism. Gold cannot absorb 300 trillion in sovereign promises. It can only mark the distance between promises and collateral. When that distance becomes visible, the system does not collapse. It reprices. And repricing does not ask permission.